Silver may look weak on the surface, but today's price action does not tell the whole story. If you are only watching the daily ticker, you are being manipulated by the noise. Welcome back. Today, we are stripping away the retail sentiment and looking strictly at the macroeconomic and structural realities of the silver market. Recent selling pressure has been intense. We have seen violent downside wicks, driven almost entirely by Federal Reserve monetary policy. A stronger United States dollar and short-term paper market liquidation have caused alarm, but beneath these headlines, a massive structural shift is occurring. Long-term trends are fundamentally reshaping the global silver market, and retail investors are looking the wrong way. In this analysis, we will deconstruct the Federal Reserve's interest rate expectations and uncover the severe multi-year structural supply deficit. We will map out the explosive industrial demand coming from artificial intelligence, solar energy, and global electrification. The biggest moves in financial history always begin when retail confidence is at its lowest. Is silver suffering a correction or building a foundation? Let us dive into the data. To truly grasp the current landscape, we must first look back at the historical context of silver cycles. For decades, silver has operated in prolonged periods of consolidation, followed by aggressive, explosive breakouts that catch the majority off guard. The retail trader is conditioned to panic. When prices dip, mainstream media amplifies the fear, citing bond yields or hawkish central bank commentary. This creates a psychological echo chamber where weak hands sell to institutional buyers who are quietly accumulating. The illusion of weakness is a deliberate mechanism of market transfer. Wealth moves from the impatient to the patient. Right now, the narrative focuses on short-term data. Robust payroll reports trigger algorithms to short precious metals, detached from physical reality. There's a fundamental disconnect between the paper price on exchanges and the physical availability of the metal in global vaults. When the physical market forces a reconciliation, the price action will be unprecedented. We are standing on the precipice of a commodity supercycle. This is driven by an inescapable technological revolution that requires silver as its foundational building block. The future is physical. To understand why the spot price is bleeding today, we must dissect the mechanics of the paper market. The price of silver you see quoted on your broker's application is not determined by a solar panel manufacturer buying physical bars. It is determined by the trading of derivative contracts on the Commodity Exchange and the London Bullion Market Association. These futures contracts represent millions of ounces of silver that often do not actually exist in the physical vaults. The paper-to-physical ratio is heavily skewed, allowing financial institutions to dictate price direction through massive leveraged trading volumes. Currently, this paper market is reacting to one singular force: the monetary policy of the United States Federal Reserve. Over the past 2 years, the Federal Reserve has embarked on the most aggressive interest rate hiking cycle in 4 decades to combat entrenched inflation. As the federal funds rate was pushed above 5%, the yield on the 10-year United States Treasury note surged. This dynamic is toxic for precious metals in the short term. Because silver yields exactly 0%, institutional capital rotates out of non-yielding assets and into government bonds that offer a guaranteed return. This massive influx of capital into the United States bond market strengthens the United States dollar against a basket of foreign currencies. Because commodities like silver are priced in dollars globally, a stronger dollar mathematically suppresses the nominal price of the metal. Furthermore, we must account for the dominance of algorithmic, high-frequency trading. Modern financial markets are not driven by human emotion on a day-to-day basis. They are driven by complex computer models. When Jerome Powell steps to the podium and delivers a hawkish speech suggesting that interest rates will remain higher for longer, these algorithms instantly execute millions of dollars in short selling orders. If key moving averages, like the 50-day or 200-day lines, are broken to the downside, it triggers cascading liquidation. Speculators who are heavily leveraged on the long side are forced to sell to meet margin calls, exacerbating the downward spiral. However, this macroeconomic headwind is inherently temporary. The Federal Reserve cannot hold interest rates at these restrictive levels indefinitely. The United States government is currently running multi-trillion-dollar annual deficits, and the interest expense on the national debt is rising exponentially. Eventually, the central bank will be forced to pivot. They will have to lower interest rates and resume quantitative easing to monetize the debt. When this inevitable policy reversal occurs, the primary headwind suppressing silver will become its greatest tailwind. The dollar will weaken, real yields will turn deeply negative, and the institutional capital will rush back in, triggering a massive short squeeze. The inevitable reversal in the paper market will likely see silver reclaim its true value as the ultimate hedge against monetary expansion. Now we leave the world of financial engineering and step into the unyielding reality of physics and geology. The most bullish factor for silver is the structural supply deficit, a mathematical impossibility that the market is currently ignoring. For the 4th consecutive year, global silver consumption has vastly exceeded global silver production. Current estimates show global demand exceeding 1.2 billion ounces annually. However, global mine production has plateaued at roughly 820 million ounces. Even when we factor in the secondary supply from global recycling efforts, which provides roughly 170 million ounces, we are left with a gaping deficit. This year, that shortfall is projected to exceed 215 million ounces. The immediate question is, why can mining companies not simply extract more metal to capitalize on rising demand? The answer lies in the unique geological nature of silver. Unlike gold or copper, silver is often a byproduct of mining for other industrial metals. When a mining company operates a zinc, lead, or copper mine, they extract silver as a secondary revenue stream. Therefore, production is largely inelastic. If the silver price doubles tomorrow, a zinc miner will not double production unless the price of zinc also justifies the massive capital expenditure required. Furthermore, the primary silver mining industry has been starved of exploration and development capital since the brutal bear market that began in 2011. It takes an average of 10 to 15 years to take a new mineral discovery from the initial drilling phase to commercial production. You cannot turn on a new mine like a faucet. Adding to this crisis is the undeniable reality of declining ore grades. In top-tier nations like Mexico, Peru, and Chile, the highest quality epithermal vein systems have largely been exhausted. A ton of earth that yielded 10 ounces 20 years ago might only yield 3 today. Miners must move vastly more rock for the same metal. This requires more diesel fuel, more heavy machinery, and more labor, all of which have been subjected to severe inflation. The all-in sustaining cost of producing a single ounce of silver has skyrocketed, compressing profit margins and discouraging new investment. Additionally, geopolitical instability and strict environmental, social, and governance regulations have severely delayed the permitting process for new projects. The world is rapidly running out of easily accessible, high-grade silver, and above-ground stockpiles are being drained at an alarming rate. When the commodity exchanges can no longer source physical metal to settle contracts, the true price discovery mechanism will finally be unleashed. While supply is inherently constrained, the demand side of the equation is undergoing a parabolic, historically unprecedented expansion. Silver is no longer just a monetary safe haven or a material for jewelry and silverware. Today, it is arguably the most critical strategic industrial metal. Silver possesses the highest electrical conductivity, thermal conductivity, and reflectivity of any known element. In advanced technology, there is simply no viable substitute. Let us begin with the global energy transition. The photovoltaic industry is currently consuming silver at a staggering pace. Solar panel manufacturing alone absorbed roughly 190 million ounces of silver last year. Solar capacity is being scaled exponentially. The industry is rapidly transitioning from older P-type cells to more efficient N-type and tunnel oxide passivated contact cells. These next-generation solar cells require significantly more silver paste per unit, sometimes 30 to 50% more, to achieve higher efficiency rates. But solar is just one pillar. The truly explosive wildcard analysts are underestimating is the proliferation of artificial intelligence. Artificial intelligence is highly demanding physical infrastructure. Training massive language models requires hyperscale data centers packed with tens of thousands of specialized GPUs. These data centers draw enormous amounts of electricity and generate extreme heat. Every electrical connection, switch, relay, and circuit board requires silver to ensure zero latency data transmission and to prevent catastrophic overheating. As trillions are poured into AI infrastructure over the next decade, silver consumption in the electronics sector will skyrocket. Coupled with AI is the global electrification of transportation. A traditional combustion vehicle utilizes roughly 1 ounce of silver in its electrical components. A modern electric vehicle requires anywhere from 2 to 3 ounces. The silver is concentrated in battery management and autonomous driving sensor suites. As the automotive industry shifts toward full electrification, this demand vector alone will strain global supply chains. The most critical aspect of this industrial demand is that it is utterly price inelastic. If a conglomerate is manufacturing a server rack worth $100,000, they will not halt production if silver prices rise significantly. The cost of silver is a microscopic fraction of the final product price, but without it, the product cannot function. They must acquire the metal at any cost. Finally, we must synthesize the macroeconomic fundamentals with the technical architecture of the chart. While the long-term fundamentals scream for vastly higher prices, we must respect the technical levels that institutional algorithms use to execute trades. Understanding these levels allows us to identify optimal entry points and avoid being shaken out during engineered price drops. Currently, silver has experienced a harsh technical rejection at the $30 macroeconomic resistance level. This $30 threshold is a massive psychological and technical ceiling that has contained the price for multiple years. Following this rejection, we are currently testing critical structural support in the $26 to $27 zone. This specific area is heavily defended for several reasons. First, it aligns perfectly with the 200-day simple moving average. Second, it perfectly intersects with the 38.2% Fibonacci retracement level drawn from the deepest swing low. If the bulls can defend this $26 level, it establishes a massive multi-year higher low on the monthly and quarterly timeframes. However, we must be prepared for all scenarios. If algorithmic selling forces a weekly close below $26, we could witness a final violent capitulation flush down to the $24 support level. This would be a painful washout designed to trigger stop-loss orders and shake out the last remaining weak retail hands. But if you analyze the commitment of traders report from the futures exchange, a clear pattern emerges. The commercial entities are actively reducing their net short exposure during these aggressive price dips. The smart money is using this artificially engineered weakness to cover their shorts and accumulate physical metal. To conclude, do not let short-term volatility and media-driven fear blind you to the overarching macroeconomic reality. The bigger story is a severely constrained, geologically limited global supply colliding with an unstoppable wave of industrial demand. Watch the $26 support level closely and monitor the relentless drawdown of physical inventories in global vaults. Silver is not dying. It is quietly, methodically, preparing for its next major historical trend. Thank you for watching. If you found this breakdown valuable, hit the like button, subscribe, and prepare your portfolio.